Every government on the planet has to figure out this one huge thing. How do you actually collect the taxes you need to pay for everything? It sounds pretty simple, right? But designing an income tax system is one of the most complicated puzzles out there. And the answer really boils down to two competing ideas, which we can think of as the one bucket versus the many buckets approach. I mean, that's the real heart of the problem, isn't it? How do you build a system that can juggle all these competing demands? You need something that people feel is fair, something that doesn't completely mess up the economy, and, something you can actually run without needing an army of accountants for every single person. So, tax experts pretty much agree that any good system is trying to hit these three targets. First, equity, which is just fairness. Then efficiency, which means the tax shouldn't make people do weird things with their money just to avoid it. And finally, simplicity, so that everyone, taxpayers and the government alike, can actually understand the rules. Now, here's the kicker. These three goals are almost always fighting each other. A system that's perfectly fair might be incredibly complex, and a really simple system, it might not be very efficient. And that conflict, that constant tug of war, has led to two main schools of thought on how to set up an income tax. The whole debate basically comes down to this. Should you just dump all of a person's income into one big bucket, or should you carefully separate it out into many smaller ones? As you can see, it really is about two different approaches. On one side, you've got the global system. Think of this as the one big bucket approach. Your salary, money from investments, rental income, it all gets poured into this one bucket and taxed under one single set of rules. On the other side is the scheduler system, the many small buckets. Historically, a lot of developing countries like this because it seemed simpler. Each kind of income gets its own little bucket or schedule with its own specific rules. Let's zoom in on this scheduler system. Its big selling point is simplicity, well, at least on the surface. By making different categories for different types of income, you can apply really straightforward rules to each one. And this approach has been around for decades in a lot of places. To really get how it works, though, we need to look at a real-world example. So, let's turn to Ethiopia. They've had a scheduler income tax system since way back in the 1940s. It's a perfect case study, really, because it shows us both the good intentions and the unexpected problems of this many buckets idea. Okay, so here are Ethiopia's main buckets. Schedule A is for your paycheck. Schedule B is for money you make renting out buildings. Schedule C is for business profits. And Schedule D is kind of a catch-all for other things, like royalties or dividends. Each one of these has its own rules for what you can deduct and how the tax gets calculated. In theory, it all looks so neat and clean. But in practice, well, that's where things start to get a little complicated. And this is where the story takes a turn. Because a system that was designed to be simple can, believe it or not, create some really clever loopholes and what one legal expert called unwarranted complexity. Turns out the walls between those buckets aren't quite as solid as they look. This quote right here gets to the absolute heart of the problem. Because the rules for what you can deduct are different for business income than they are for rental income, a single company can end up splitting its profits between two different schedules. And when that happens, it opens the door for some, let's call it creative tax planning. Let's walk through exactly how this works. So picture a bank. Its profits from normal banking stuff gets taxed under Schedule C, the business bucket. But the bank also owns its headquarters, and it rents out a few floors to other companies. That rental money gets taxed under Schedule B. All of a sudden, one company's income is artificially split in two. And because the rules for each schedule are different, this whole setup can lead to a smaller total tax bill than if all that money was just lumped together in one big bucket. And that creates a major fairness issue. Two businesses could have the exact same total profit, but end up paying totally different amounts in tax. So yeah, the many bucket system clearly has its problems. But hold on, that does not mean the one bucket system is perfect. In fact, both systems, and every system, are facing a much, much bigger challenge. A globalized economy that doesn't really care about a country's domestic buckets. Every single nation has to find its way through this incredibly complex maze of international tax law. Just look at this number. There are over 3,000 bilateral tax treaties in the world right now. Each one is a complex, negotiated agreement between two countries about who gets to tax what and how they get to tax it. This tangled web of treaties creates a whole other layer of rules that just sits on top of whatever domestic system a country has, whether it's one bucket or many. And inside that web, you find things like transfer pricing. This is a massive deal for big multinational companies. It's all about how you set the price for something sold between two different parts of the same company, like, say, from a subsidiary in Ireland to its parent company in the US. Getting that price right is what decides how much profit gets taxed in each country. And these super complex international rules have to somehow work with a country's local system, adding yet another layer of difficulty. And if all that wasn't complicated enough, the modern digital economy is just breaking all the old tax rules. Our tax systems, both the one-bucket and many-bucket kind, were designed for a world of physical things, factories, offices, shops. So what do you do with a streaming service or a software company that has millions of customers in a country but doesn't have a single physical office there? It's a huge question that basically every tax system on Earth is trying to figure out right now. So where does all this leave us? We've seen that trying to separate income into lots of little buckets can create some strange loopholes. But we've also seen that all systems, even the unified one-bucket approach, have to wrestle with the mind-bending complexity of a global, digital world, which brings us right back to where we started. Maybe the goal isn't really to find one single perfect system that solves everything. Every choice you make, one bucket or many, simple rules or complex ones, is a trade-off. It's a balancing act between those core goals of fairness, efficiency, and simplicity. So the most important takeaway might be this. If every system is going to have flaws, the real question for policymakers isn't how do we build a perfect system, it's which problems are the most important for us to solve right now.